Financial Accounting, Chapter 12, Corporations, the organization of a corporation, stock transactions, and dividends. So this is our concluding chapter in financial accounting, and we're going to talk more about the statement of stockholders' equity and the transactions that affect this financial statement, involving the declaration of dividends and stock issued at par or above or below par. We're going to be talking about how corporations are organized. There's a little bit of this chapter that was discussed in our very first chapter, so it's appropriate that we conclude with this last chapter on the corporate environment. This is a long list of our objectives, so we're going to start by talking about the nature of the corporate form of organization. As you recall from the first chapter, businesses can be set up as a sole proprietorship. That just means one person. That one individual actually reports the income on their individual tax return with a Schedule C. An organization, can be set up as a partnership with two or more partners. And those individuals will file a partnership return that flows through on their individual tax return. Finally, an organization can be set up as a corporation, and that's what we'll be talking about here. The corporate form can actually have only one shareholder, and that one shareholder owns 100%, and it's organized the same way as if there are millions of shareholders, as is the example of every company from IBM, Coca-Cola, even Snapchat. So corporation, as we've said before, is a legal entity. It's separate from the individuals who create it and operate it, and this corporation files its own separate tax return and sells shares of ownership, which are called stock. And these stock shares can be transferred and they don't affect the business at all. So if an individual owns stock in Microsoft or Amazon, they can turn around and sell that stock to anyone else they want to, typically by the click of a mouse through the internet, and it doesn't affect anything related to the business at all. The corporate form of business has many advantages. One of them is that the shareholders can't be sued if the corporation has a lawsuit against it. It's easy to transfer ownership. There is no mutual agency, which means, for example, if one person owns shares of stock in Amazon, they're not allowed to go out and perform business on behalf of Amazon because of this bullet down here that talks about centralized authority. And that centralized authority is through an elected board of directors and professional management. So if an individual owns Amazon, they cannot make any decisions on their behalf. It has to go through the board of directors that's elected and through proxies that are sent out for votes related to the company. And there's also continuous existence, so no matter what happens to a shareholder. Disadvantages of the corporation are government regulation. The government has lots of rules and regulations, particularly if it's a publicly held company. The SEC, or the Securities and Exchange Commission, really has some strenuous regulations that the company has to adhere to, including Sarbanes-Oxley. There's double taxation. That means that a corporation that pays dividends to its shareholders is not allowed to deduct them. And that means that the company has earned money and distributed it to the shareholders, and they can't deduct it, so it's paid. The taxes are paid by the shareholder and the taxes are paid by the corporation. When you contrast that with the fact that interest is deductible, then when a company borrows money and has to pay it back with interest, then that is going to be a tax deduction. We also have limited liability, and this is a little unusual to think about, but shareholders can't be sued, and frequently this disadvantage means that a shareholder who's done something that they shouldn't can't be sued, and it can cause a problem because there's this limited liability that's that disadvantage, particularly if the shareholders in management. Separation of ownership and control is another disadvantage because if a shareholder is frustrated with something the company's doing, there's nothing they can do. They own it, but they don't. So here's our structure. We've talked about this before. The stockholders own the company and they elect the board of directors. The board of directors chooses the officers, and the officers of the company hire the employees and work on the goals of the business. So this is a summary that might be helpful. It's in your text. Of course, we won't be reading through it, but I think these types of ideas will be good to review before you take your exam related to Chapter 12. So in forming a corporation, you file an article of incorporation. They call it an application of incorporation within a state. And different states have different laws of incorporation. And Delaware, as you'll see on the next slide, has a tremendous number of businesses incorporated in it. They have preferential incorporation laws and fees. After the application has been approved, then the articles of incorporation and the charter is granted by the state. And now there's a legal separate entity called a corporation. And management and the board of directors set up a set of bylaws, which may be everything from how frequently dividends are paid to the process for determining management. Costs are incurred when you organize a corporation. Here's a nice long list, and these expenses are called organizational expenses. They can be pretty hefty when you set up, when you think about all the legal fees that you have to go through, sometimes the marketing analysis that you have to do. So let's talk a little bit about stock. The main source of money coming in to stockholders' equity in the paid-in capital section comes from issuing stock. And the stock is issued according to the charter. So the state within which the company is chartered has an authority to issue stock, and they will have a certain number of shares that they can authorize. And when they are issued, the stock means that that has been paid out to shareholders, and the shareholders have paid for the stock. It's more of a paper trail now. It used to be that a shareholder literally received a piece of paper that had a share of stock. And the stock remaining in the hands of the shareholders is called outstanding stock. There's actually a term that's not discussed in this chapter for treasury stock or repurchased stock. And this will be talked about in the annual report project that you will do in your BADM 212 class. And this is stock that was at one time outstanding and the company has purchased back. So here's the way it goes. We've got a huge chunk of shares that we can authorize, and then we've got a bunch that we have issued, and some of them are still outstanding, and these in green are those that would be in the treasury. Shares are often assigned a dollar value called a par value. And this can be very frustrating for students because it doesn't seem to mean much, because stock can also be issued with no par stock. This is more of an old leftover rule from back in the day whenever companies had to have the exact same amount of cash in the bank that they had with par value of stock. That's not necessarily the case now, although some state laws still have a minimum amount of paid-in capital required. But nonetheless, there is this arbitrary amount called par value on a lot of companies. And when an individual buys a share of stock, they have the right to vote. They have the right to share in any dividends that are accruing to their shares of stock, and they have the right to assets in case the company is liquidated. Now, as a reminder, if the company goes bankrupt, which would mean they're liquidated, and they decide they're going to sell off all of their assets, yes, the stockholders will get money, but the creditors, the bondholders, and the people who have loaned money to the company, those guys will receive their assets first upon liquidation. So these are the basic characteristics of a corporation.